Hi everyone, my name is Chris Sibamalai. Welcome to another episode. In this episode, we are going to look at the type of stocks. Before we get into the video, if you haven't subscribed, please subscribe to my channel, and I have put my bio and the disclaimer here. Please read the disclaimer, as the information I mention here are just for education and entertainment purpose only. This is not a financial advice. Now, first look at common stock versus preferred stock. Most of you are already aware that the common stock is also called ordinary shares. Ordinary shares or common stock represents the ownership of a company. That means the shareholders of a common stock has the voting right to vote at the shareholders' meetings. Usually, each ordinary share carries one vote. Since this represents ownership of a company, usually there is no guaranteed dividend, and owners are usually last in line in terms of getting payments during the liquidation process, if the company ever goes into liquidation. Usually, common stock is good for growth-focused investment and long-term investment. Now let's look at preferred stock. Preferred stock is also called preference shares, and the dividends for preference shareholders are paid before ordinary shareholders, and usually the dividend is a fixed amount. Preferred stocks usually doesn't carry a voting right, and this type of stock is good for retirees seeking for stable income, as the growth can be very limited. Now let's look at the classification of stocks based on investing. First, let's look at dividend stocks versus non-dividend stocks. As the name says, dividend stock means stocks in companies that pay a portion of their earnings to the shareholders on a regular basis. These companies are usually very well established and they have stable income source. The pros with these companies is very safe and you get regular income. However, the cons is the growths can be limited, so you are not going to get much growth out of your stock. However, you will get dividend income regularly. Examples include S&P 500 ETFs, Johnson & Johnson, Wells Fargo, Target, and many more other companies that pay regular dividends. Now let's look at non-dividend stocks. Non-dividend stocks means stocks in companies that don't pay regular dividends to shareholders because they use the earnings to reinvest in their growth, in the growth of the company. Usually these are growth companies. That means you will get much capital growth out of your stock, but you won't get much dividends. The issue with these type of companies is if the company doesn't grow as much as you expected, you might lose all your investments. Examples for non-dividend stocks are Tesla, Netflix, and Amazon, and many other growth companies like Joby Aviation and other companies. Now let's look at value stock versus growth stocks. Value stocks are usually undervalued stocks, and they have relatively cheap valuations compared to their earnings. And usually these type of stocks have low price to earning ratio, but they have stable earnings and pay dividends. These type of stocks are less riskier, as value stocks are less volatile and usually pay dividends, which is significant advantage during bear market. However, the downside here is less growth potential because value stocks usually underperform the market during the economic recovery or during the times of economic growth, as these are usually stocks of well-established companies. Investors can usually access a portfolio of value stocks using exchange-traded funds. Usually investors invest in these type of stocks just to be less riskier or with the expectation that the market will recognize the true valuation of the companies at a future time so they can make money out of it. Growth stocks are stocks of companies which are expected to grow significantly higher than the average market growth rate. Usually these type of companies don't pay any dividends or very little dividends because the earnings are reinvested into the business to accelerate future long-term growth. These type of stocks are suitable for long-term investors. Growth stocks are usually in emerging industries like tech or biotech, and these type of stocks have higher price to earning ratio. And the focus here is not on valuation but on future growth potential. The goal of the investors here is to make money through capital gain in future by selling the stocks at significantly higher price than what they bought for. Usually these type of growth stock companies have their unique innovation such as patents or new technology, and the expectation here is that they will significantly grow globally and expand their business. Investors invest in these type of growth stocks to benefit from the capital appreciation from stock price increase, and these type of stocks are suitable for long-term investors. As I said, growth stocks are usually high return, high risk and highly volatile. And if something wrong happens, the investors could end up losing all the money. Examples of growth stocks are Tesla, Joby Aviation, etc. Most of the big companies like Google and Apple used to be growth stocks. Now let's look at some examples of growth stock. Let's look at Tesla shares. I'll click on the maximum share price history. And as you can see here, back in 2010, Tesla shares used to be $1. But earlier this year, it hit $488.54. That's the maximum price it hit. Imagine if you had invested $1,000 back in 2010, you would have made around $480,000. This is the advantage of investing in growth stocks. Let's look at another example. We'll look at Netflix. Again, I'll click on the maximum share price history. Back in 2002, it used to be $1, and then now it is $1,195, and the return is 98,668%. Wow! If you have invested $5,000 back in 2002, you would be a millionaire by now. This seems really wonderful. However, not all growth stocks perform like Tesla and Netflix. We'll see some examples now. Let's look at a company called CureVac. Again, we will go to the maximum share price history. As you can see, this was an unsuccessful COVID vaccine developer. The share price started trading at about $56 US and went up to around $120 US, but it is down now to $3.72. If you had invested back in 2020, you would have lost almost all your money. So the conclusion here is to do a lot of research and choose the stock carefully. Now let's look at cyclical stocks versus non-cyclical stocks. The difference between cyclical and non-cyclical stock is basically depends on how sensitive a company's performance and its share price is to overall economic cycle. Cyclical stocks are directly correlated with economic growth. These stocks perform really well during the economic growth and very poorly during recession or economic downturn. Examples of cyclical stocks are travel and entertainment, luxury goods, automobile, and industries like that. The reason they perform better during economic growth is because the consumers will have extra money to spend during economic growth. The pros of cyclical stocks are they are very profitable during economic growth, but the cons is very volatile and perform really badly during recession. Non-cyclical stocks does not correlate with economy because they are usually stocks of companies that provide essential goods and services. As these companies provide essential services, the share price of these companies are not really volatile during economic growth or economic downturn. Examples of these companies are consumer staples, food, energy sectors, and healthcare sectors. The advantage here is these type of stocks are relatively safe and they can withstand poor economic conditions. But the disadvantage is they don't grow as much as other stocks during the economic growth. Now let's look at defensive stocks versus speculative stocks. Defensive stocks are usually stocks of companies that provide consistent dividends and stable earnings regardless of the state of the overall stock market. Defensive stocks are usually non-cyclical stocks and therefore they perform relatively well during bear market, but often leads to smaller gains during bull markets. Examples of defensive stocks are just like non-cyclical stocks, just like the stocks in companies in the consumer staples, utilities, and the healthcare sectors. Speculative stocks have high potential for larger gains, but also there's a potential for larger losses as well due to the uncertainty about the company's future performance. Examples are early stage mining companies, technology, and biotechnology sectors. These type of speculative stocks generally outperform in very strong bull markets when the investors have some risk tolerance and underperform in bear markets. While there are significant risk involved in investing in speculative stocks, the possibility of finding a giant mineral deposit or discover a cure for a disease triggers speculators to take a chance, because if that happens, the return can be huge. But if that doesn't happen, you could end up losing all your money as well. Usually penny stocks are speculative stocks. Okay, that's the end of this episode. If you haven't subscribed already, please subscribe to my channel. I'll see you in the next episode. Thanks for watching.